Hey everyone, my name's Mike Marshall. I'm with the Benzing team. I'm here with the head of our news desk, news team here, Brent Slava.
Hey everybody, thanks for joining.
So today what we're going to do is we're going to be talking to you guys a little bit about how to research a stock. We're going to be doing a few of the basic fundamental tips. Brent here is going to lead the charge of the educational portion. And, if you're an advanced trader, hold tight. Towards the end of the webinar, we are going to show you something that will add value to what you're doing on a daily basis. So if you guys do have any questions, feel free to drop them into the chat. We'll make sure to get to them. And Brent, is there anything that you want to add in before we get started?
I don't think so. I think that we've been working pretty hard on this presentation. I think everyone out there is going to like it. So I'm excited. I know you're excited.
Absolutely.
The whole office is pretty excited.
Great. So here we go. Brent, if you don't mind, just kind of giving us a little overview of what we're going to talk about today.
Cool. So when we were thinking about the topic of the webinar, how do you research a stock? I sort of took myself back to my early days of getting into investing and trading, and I started thinking, how was I doing this kind of stuff? 4 things that I want to go over pretty quickly. If you have these 3 or 4 things for your first investment, for your first trade, I think you're going to have a good start, and you can kind of sort of work from there. So the 3 things that we're going to go over, and then sort of the little surprise at the end, we're going to understand how you can learn about the company itself. We're also going to understand how important a sector is that the company operates, and how you can use this to get information about a company you're looking at. And then the third thing that we're going to talk about is recent price action in the stock. Pretty basic stuff, right?
Absolutely, absolutely. And so just to make it, so everyone's on the same page.
Sure.
A company has a stock ticker, correct?
Yes, sir.
And then there are these companies that are divided into what are called sectors, and what are there? How many different sectors are there?
There's like 7, 8, or 9 sectors, and then kind of from there, there's like industries, sort of like subsectors within those sectors. For example, in the technology sector, there is a security industry, which is, like cybersecurity and that kind of thing. So it's kind of drilling down from there.
Excellent. And so if you're thinking about adding a technology stock or buying some, kind of taking a look at the whole sector might be something that you'd want to do. Is that kind of?
I would say it's absolutely something you want to do. Not just a might. It's a for certainty. And we'll kind of get to that when we get to the sector section. I'll point out a cool little something to what you just said, Mike.
Awesome. So sorry for getting a little ahead of you here. Here we go. So understanding the company itself.
That's right. So give me another click here. So where are you going to find information about learning what's going on with the company? What kind of operations do they have? What sector are they in? There's a few things you can do here. The first one is you can go right to the company website, right? Seems easy enough. You're going to get a good amount of information here. Remember that on the company website, they are going to be a little bit sort of, promotional. It's going to be for a broader user than for somebody that is researching a stock. So while the company website is a really good source to get started, it's not going to be, in my opinion, the spot where you're going to be able to get the most information about a company that you might be looking into. Another spot where you can get some information about a company is a press release. So via press releases and SEC filings, which is the next one I'm going to touch on, is where a large majority of all the news that a company could announce is going to come from. I am one of the guys on the news team that is watching news wires all day long, and I have, a ton of different sources that I'm using. Still, probably a large majority, 60 to 70% of all the headlines that we're putting out on our breaking news platform comes from either a company press release that it itself wrote, or an SEC filing that has, strict guidelines as far as what stuff needs to go where. And so kind of, alluding to that, SEC filings is probably the spot that you're going to be able to learn the most about a company. We can look at things like an 8K filing, which is sort of like a general announcement. We can look at an SEC filing called a 10K or a 10Q. It's like the full rundown of all the company's operations, regional statistics, segment statistics. It's going to talk about your the company's competitors. It's going to talk about the company's suppliers. It's probably the spot where you can get the most information. The one sort of caveat there is it is pretty advanced. There's a ton of information. You do need to get rather familiar with the format, but the upside there is with the SEC filings, the SEC requires that the companies be very formulaic with the stuff that they're submitting. So the sort of silver lining in the complexity of SEC filings is that if you know how to read one filing, you're probably going to know how to read another 10Q or 10K filing.
Awesome. Thank you for that. And just to recap, we're just getting started here. I know there's a lot of people that are still signing in. Pretty much what we have done is just talked about the three things you can do to start to research a stock. One would be, first of all, go ahead and get on that company's website. Usually 9.5 times out of 10 on that website, you'll see a press release section, press section.
Exactly, good call.
And you can take a deeper dive into that company right there on that website. So we have just gotten started here with the presentation. So you guys have not missed much. Just had Brent tell us a little bit about some of the different forms, SEC, and press releases that you will see out there in the investment world.
That was a great little recap, Mike. Thanks for doing that, because we are getting a few more guests in here a little late. Guests that are just a little late, wanted to offer that if you do have any questions as we're going through this stuff, please throw them in the chat. We can, if it's kind of like an urgent question, we might get to it right away. If it's something that can wait, we'll let you know that we see your question and we'll get to it at the end of the education section.
And yes, Eva, really appreciate the questions so far, so keep them coming.
Awesome.
So moving forward, Brent, keep us rolling.
Great. So the next sort of step you might want to consider is, after you understand what a company does and what they're about, is what is the current market perception of the company? How is the market valuing that company? So a good way to do that is, there's a couple things that you can do that are sort of outside of this ratio analysis, and those would be, you consider their market cap. What is the size of the company? How much does the market currently value a company? And you see a quick little breakdown of some of the market cap classifications here. A mega cap is going to be a company, it is one of the biggest companies in the world. A large cap is between, let's say under 50 billion and over $20 billion. Small to mid cap will get you from about 15 billion down to around $2 billion. Micro cap is where you're getting under the $1 billion, and a nano cap is going to be like under 350 or $100 million. So why are these important? Really quickly, as you go down the scale that I just read off, from mega cap to nano cap to micro cap, you're going to be decreasing your liquidity. If you get into a mega cap stock, you're going to be able to trade it any day you want. There's going to have to be some very out of the ordinary exception where you can't trade that one. As you're going down toward a small cap, and definitely into micro cap and definitely into nano cap, it's not a guarantee that you're going to be able to trade out of that stock, for example, if you own it, meaning the liquidity is reduced. So that's definitely important to know. That's definitely something you want to know right away before you go pulling the trigger and buying a small cap company or a micro cap penny stock, and then you're kind of stuck with this thing for a while until there's another buyer of the shares that you want to sell. So moving along here, the next important stop in sort of considering how the market might be valuing a company is based off their actual performance. A top way to consider, and not like a stock's performance, but we're talking about like the actual operations here. And a really good way we can do that is we can look at the company's quarterly and fiscal year earnings and sales. These are the two most important metrics you're going to look for when a company reports their quarterly earnings. There's definitely, a ton of other metrics that are important to companies. However, these are kind of the ones that all companies will do. And a quick little side note here, if you have ever heard a publication or a source say top line and bottom line, where does that come from? So that comes from the earnings and sales. It's from the actual income statement that a company reports. Top line, that's the very top of a company's income statement. That's their sales or revenue figure. The bottom line, which is their profit or loss, is their earnings, and it's actually physically at the bottom of an income statement. And we're going to really quickly, towards the end of this, we're going to get into an earnings report if we got some time, and I'll actually get to show you what the income statement looks like and what might be important there. So now kind of moving on a little bit closer to sort of market perception of a company valuation is the PE ratio, and that stands for the price to earnings ratio. So a way that I like to explain the PE ratio is it is how many times the market is willing to pay for $1 in earnings from a company. So let's take a quick example here, and we can just sort of make up a company here. If we have company ABC that is reporting $1 in earnings and it has a PE ratio of 10, it means that for every $1 of earnings, those shareholders are going to be getting back, they're willing to pay up $10. So that seems kind of weird. Wouldn't they only pay $1? But no, the market is wanting to pay for growth. And so if we look at sort of like an average, we can say that, have you ever heard of a company or a stock be referred to as a quote value company or a quote growth company? That's actually referring directly to the PE ratio. Traditionally, historically, if you have a company that has a PE ratio under 10 times, that is considered a value company. With value, you're getting, you know, a very consistent revenue stream. There's not a ton of growth prospects, however, but if it's like, you know, something that you want to put some retirement investment money in, that's usually a good bet. The other side of that is a company that has a PE over 20 times is generally considered a growth stock. So again, the market is willing to pay more for that growth. They're willing to pay more for future prospects. How do you think about that, Mike?
So you kind of can see if it's going to be a longer term play or if it's going to be a little more risky play.
Not necessarily longer term. Don't think of the timeline necessarily there, but the riskier or risk averseness is a really good way to put it that I didn't describe there. So
great. And also Eva did have a question here. Do you consider relative PE equals relative to itself as opposed to compared to the market?
Absolutely. So what you're asking here, Ava, is saying, you know, for example, let's say that across the S&P 500, let's say out of all the companies that are in the S&P 500, the S&P comes up with one PE ratio. It's an average ratio that is taking every company into, and it's spitting out like a 14, let's say. The PE ratio is 14. I'm making that up right now. How you position yourself is you can position yourself versus the market to have sort of under normal price to earnings multiple or sort of over that average multiple. So the fact is that on a given year, on a given investment cycle, that PE ratio of the overall market is going to change. So in other words, maybe one year, who knows, the PE ratio of the S&P is 10. If you're betting on a 10 PE ratio stock, you're really only betting with what the market is offering you on that year. If if it jumps up to a 20 ratio for whatever reason in a given year, and you take a growth stock, generally historically growth stock, you're really only sort of getting what the market might give you. So it's a really good call, Ava. Thanks for that question. It was really good for me to point that out. So appreciate that.
And then we can get into the Amazon example here in just a little bit.
Yeah, let's do it right now. So just to give you a couple examples of, some companies that I'm sure a lot of people out there in the audience are going to know. GM. Right now, GM, or not right now, but at least when I checked a couple of weeks ago, GM had the lowest PE ratio of any company in the S&P 500. So what that actually means, and that ratio was about 5.6% or so, 5.6 times or so. So out of all the companies in the S&P 500, the market was willing to pay the least amount to get their $1 of GM earnings. Let's take another couple quick examples here. So Apple, you know, sort of considered, I would say still sort of considered a growth stock. We're looking at a PE of about 18 times right now for Apple. And I'm giving you the example because I'm trying to position the listeners out there to sort of understand what I'm talking about. On the high end, Amazon is probably one of the top growth ratios that we have out there right now. Amazon is current PE of about 238 times. So let me just say that again to give a little perspective, to make a little gravity there. To get $1 in Amazon earnings right now in the marketplace, the market is showing us that they're ready to pay $238 just to get that $1 of earnings back.
Wow.
Pretty crazy, right?
Yeah.
But that's the environment that we're operating in right now. So I'm going to keep going. One quick question here from Hanan. What is a negative PE ratio? That can happen when a company is not turning in earnings. They're not turning a profit, when they're still in a loss. So that can actually happen. Let's move on though, and let's keep going here. PEG ratio. So this one stands for the price to earnings growth multiple. This is an important one. These are all pretty basic, but I want to get you started off here. Price to earnings growth is the same thing as PE, except for the amount of growth that a company is exhibiting in their earnings. So in other words, if you have a PEG ratio of about 1.5 times, the market is ready to pay up about 1.5 times a company's current earnings growth rate in order to get that stock. And so if, you know, I gave you a couple quick examples for PE, let me just give you a sort of a blanket statement here for PEG. If you are right around 1 times price to earnings growth, that's rather conservative to appropriate. If you are getting a PEG ratio that's nearing 2 and going over 2, it means the market, it means you as an investor, you're willing to pay up a little bit more for that. That's where you can maybe start saying, okay, this is getting a little bit expensive on a ratio basis. So we got some really good questions rolling in here. Let me see, let me just glance over them here really quickly. Ava's saying, do you like a PEG less than 10? Okay, yep, Ava, you're saying, yep, for value, generally nearing 1 or less is good. If you're looking for growth, it's generally closer to 2. So I'm going to keep going here. So let's talk about the current ratio right here. Why this is important is this is a good measure of a company's liquidity level. So what the current ratio is the company's assets over their liabilities. It's how many times over they have in assets over their liability. So it'll show you if there was some scenario where the company had to liquidate and they had cash left only, it would really quickly show you how much more cash they're going to have for debt. You want to see a current ratio that is in the positive. If you have a current ratio that is under 1 or going into the negative, it means that they have more debt than they do have assets. Now, that doesn't necessarily have to be a bad thing. If a company is in their growth phase where they maybe are acceptably, appropriately taking on a lot of debt, that could be fine if it's going to be to fund their future growth. Let's keep going. Dividend yield. So this is a good indication of how much a company wants to give back to their shareholders. So there are 2 kinds of shareholder payouts. There's a dividend and there's also a buyback. Dividend is where an investor is actually getting cash for holding shares. A buyback is something that a company does to sort of put a bottom into a stock, if you will. A company can do a buyback. They can say, we're going to buy back $5 billion of our stock over the next year. They can go to the open market and they can actually buy their own shares and retire them if they want to. And if the company's actually buying shares, so what happens when any player in the market buys a stock, the stock goes up. So it's kind of a way where a company can choose to smooth out a little bit of lumpiness in a chart. What the dividend yield is it is the annual dividend payment. Most companies pay a quarterly dividend, so you got to multiply that quarterly number by 4 and divide it by the company's current price, the company's current stock price, and it's showing you how much of the dividend is contained in that stock price. A good dividend number, well, I don't know about a good dividend number, but sort of an average dividend number is dividend yield number is like a 1 to 3%. If you're getting a dividend yield that's over like 3 or 4%, that's a pretty fat payment. The company is really rewarding you for holding their stock. Okay, so just a quick heads up here. This was kind of like the longer slide of the presentation. So I know we took a long time on that, but that was a lot of good information. Most of the slides will be a lot quicker than that will be.
Excellent. It was some very good information. Andrew, Graham, this is recorded and will be going out after. I believe we do have.
Go up a little bit here. Hanan, you asked what, excuse me, keep going down there, Mike, please. Ricky Yu, thanks for flagging us. What is the market mean? It was a typo in the slides. It's supposed to say the market. Sorry about that, everyone. Okay.
Then did we go over?
Let's see. Okay, William. So you like the PE ratio to industry sector more so than earnings per share to the industry sector. If I'm understanding your question right, I don't like, personally, I don't think you should like one or the other. It's just another sort of way to value a company. It's another, I'm going to probably use this a couple more times in the presentation. It's another tool in your tool belt. So I'm, giving you should be considering the market cap. You should be considering earnings to sales. You should be considering the PE ratio, the PEG ratio, all this stuff. You don't ever want to make an investment decision on any of these things alone. You want to sort of research all of this stuff together. You want to make a little cheat sheet for yourself, and then you kind of want to make your decision based on all of this stuff.
Absolutely. And just one thing that I want to make sure a lot of our listeners do know, with these mega cap stocks compared to large cap stocks, compared to the smaller cap stocks, you're obviously going to be able to find the news on the larger stocks compared to the small stocks. Yep. They just don't have the publication or the reach to really get out to the news outlets and continue to give them updates on what is going on with their company. That
is a really, really good point. So yeah, you're generally probably going to get less information about like a small to micro to nano cap company. Really, really good point, Mike. So let's keep going here into sort of what's going on with the sector and why this is important. So give me a click here if you don't mind, Mike. So a couple things that I want to point out to everyone out there on, sort of how the sector works and why it's important. Peers are hugely important for you to be considering one stock. Now, you can really get a good feeling for what one company in the sector is doing if you compare it to all the other companies that are closely related. Let me give you a really quick example of where considering close companies in a sector could be important. Let's say that you let's say you have an investment thesis that you think that car sales are going to be great this year. So you've heard about Tesla a lot, and you heard the stock's going crazy, and you've heard about Elon Musk, and you might want to get involved in Tesla. If you consider sort of how Tesla operates in the market, maybe they're probably not the right exposure for you. In other words, Tesla doesn't sell a lot of cars. So if your strategy is to play a strong year of auto sales, you need to look at how many cars GM manufactures. You need to look at how many cars Ford manufacturers. You need to look at how many cars Toyota manufactures versus Tesla to really understand if that's where you want your exposure to be.
Absolutely. And I think that was a great way to explain that.
Yeah, cool. So the other thing that's important when considering the sector is sectors will move together. So if there is news, out of DC, out of the White House, that it's related to net neutrality and it's related to technology companies using Wi-Fi across the country, this is something that is going to impact the entire technology sector, probably not just internet companies. So by sympathy play, what I'm saying here is it's sort of like read through, meaning like if you see concerning numbers from a chip company like Western Digital, a lot of times, honestly, like 90% of the time, Seagate, another chip company, is going to move with Western Digital. So another couple quick examples here of sympathy plays, peer plays, Hasbro and Mattel, two toy makers. There's nobody else in the toy space. There's no other toy manufacturers that are publicly traded. So if, for example, you hear a headline that says Hasbro had a great second quarter, their sales were through the roof, they're selling the most toys that they've ever sold, you could make a bet that Mattel might also be having a really good quarter. That's a quick example of read-through, and that's a quick kind of example of, a sympathy play. Real quick, another sympathy play that I'm sure a few of you might heard out there is like Apple suppliers. So, Apple iPhone, it's 60 to 70% of their sales right now. All the component makers that put parts into an iPhone, when Apple is selling iPhones through the roof, those suppliers are probably also going to be doing pretty well.
Makes sense.
Makes sense. Cool.
And so you could almost look at that as, when the toy
Example.
Yeah. If you think of it as the sympathy play, any news that's coming out for one of the two is probably the same news that's coming out for both of them.
Well, look, you at least know where to position yourself. So you could say, yes, they both are performing pretty well, or if in your research you can find out that there's something that Hasbro is really doing, it's something that management has been focused on for the last few quarters to separate themselves from Mattel and go in the opposite direction, at least you've positioned yourself in that sector to go, okay, Hasbro's kicking butt right now, but I know Mattel isn't doing the same things. Maybe I can come to what some traders call a pair trade, where you sort of like double your exposure by taking a bet in both directions. So for example, you go long, you buy shares of Hasbro, and if you're very convinced that Mattel isn't doing the same things that led to her Hasbro's benefit, you could consider playing the downside on Mattel by shorting the stack.
Very interesting.
Cool. So Mike, are there any quick questions?
Yeah, we got a couple. Eva's keeping us on our toes.
That's good, Eva. Thank you.
Do you want to go ahead and
let's see.
Looks like Foot Locker and Nike.
Ooh, that's a good one. Yeah, so Eva highlighting a couple other peers for us here. Thanks, Eva. So she's saying, Foot Locker dropped when Nike had concerning results, as an example. So that's another good one. Yep. Let's see. Eva's saying Newmont is the only SP 500 mining stock. However, it doesn't always move with the gold prices. Would you consider this to be a peer? So you're sort of comparing you're kind of matching apples to oranges there, Eva, in your example, because you're using a commodity versus a stock. Those aren't necessarily peers, but gold is absolutely a huge component to how Newmont trades. And just real quick, Eva, if you are interested in, trading gold stocks, an ETF, a couple ETFs that I like to use, you can use the GLD. That's like the ETF that tracks gold all by itself. And sort of to your question about Newmont, there is another ETF instrument. It's called the Gold Miners ETF. It's ticker GDX. So GDX has more of an exposure specifically to the miners versus GLD, which is pretty specifically tied to the price of gold itself.
Excellent. And then it looks like Tessa has a question here about derivatives.
Okay, so please explain derivatives and what is involved. Okay, so I'm just going to hit this really quickly because it's kind of far away from, and maybe a little bit more advanced, Tessa. A derivative is basically when an instrument is created which is derived from an underlying asset. So right now we're talking about stocks and equities. A derivative would be an options play, would be an options contract. It's not the actual stock, but an option is a derivative of what's going on with the underlying company, and it's sort of this instrument that is created. This is a huge topic, Tessa. I really appreciate you bringing it up, but it's something that we could have, and we probably will have its own webinar upcoming on, because it's just a really huge topic. So I'm going to keep rolling here on the presentation.
Thank you, and thanks for bringing that to our attention.
Yeah, now we got a little bit of ammo for potentially our next couple webinars here, Tessa, so appreciate that. So a last thing that I want people to be considering as they're considering their, potentially first or maybe some of their first few investments is recent price action. Why would I be bringing this up? Well, price action is a function of expectations, and those expectations are adjusted by the market all the time. Expectations are set by the sell side those are the researchers that are closely attached but separate from some of the investment bankers like Goldman Sachs, Morgan Stanley, Wells Fargo. All those banks have research arms. And what those research arms are doing is they have these highly advanced models. They have huge teams who are researching a ton of stocks, and they're creating expectations, forecasts for how much those companies are going to earn over the next quarter, 2 quarters, year, 2 years, 3 years, 4 years. As these expectations adjust, the market has to react to those expectations changing and will basically have to correct the price. So like, for example, why this is important, why you should be thinking about it as you're going for your potentially your first investment, is if you look at a chart, after you've researched what the company does, after you've researched what kind of sector they're operating in, you can look at the chart, and if a company has just been off to the races, stocks up 200% over the last year, what you need to know is that company is going to need to really keep beating expectations strongly to get the stock moving higher. So that it doesn't always happen that, you know, a company with high growth expectations misses and the stock just gets absolutely creamed. It doesn't always happen that way, but it's something that you should absolutely be positioning yourself for. The opposite of the example that I gave right there would be if you see a stock that has expectations move sharply lower over the last few months, and with those expectations, the price has moved lower. Well, you know, the market has already corrected for some of those issues. So it's something that you might want to consider here as you're looking for one of your first trades. So something else that is important when you're looking at sort of a chart of a company is volume. And I was kind of touching on this a little bit before when I was talking about, you know, market cap, but volume, intraday volume, it's something that you can pretty easily view on most charting systems. It'll tell you how many shares of a stock has actually traded within a session. You can also get like an average of how many stocks that have traded, how many shares have traded over the course of a day over the last 30 days average. So what you can do here is you will get some insight into liquidity. So I said market cap is a good indication of liquidity. Volume also is a very good indication of liquidity. As far as some notable levels of volume, if you pick a stock and you're researching it and you see volume that is under 100,000 shares or under 50,000 shares, what you need to be thinking about is that it might be hard to get out of that trade. You might not always be able to trade that stock at any given moment in the market. High volume stocks, like a Bank of America, which can sometimes trade over 1 billion shares in a day, you're always going to be able to trade that thing. There's always going to be buyers and sellers out there. You should never worry about, you know, potentially wanting to buy more shares or get out of some of the position that you have. Another way that you can be using volume against its average 30-day volume is to gauge how much interest is in a stock for a current day. So like, for example, if you find out that, you know, you're looking at a stock and you see that average volume is about 1 million shares on a day, and you look at the volume today and you're only seeing that there's 500,000 shares traded with only an hour left in the trading day, for some reason, traders and investors are just not interested in it today. The other side of that is if you see a stock that has, you know, average daily volume of about 1 million, and for some reason today the stock has already traded 14 million shares and you're only halfway through the day, there's something about that stock today that you should find out what's going on. It might be news, it might be an activist getting involved, something like that.
Excellent. Thank you. So, you know, paying attention to if there's a spike in volume, it could mean that there's some news circulating that might not have made it to the public yet.
Maybe, or maybe it just means that you need to go find out what the news is so that you can start pricing that into your equation of what the stock means to you. The market is all about being the most up-to-date on what's new information. If you are trying to get ahead of some of the news and you're trying to price in news to your own model right away, and you see that there's a discrepancy from how your model looks and what the market is actively pricing in, that's a huge, potentially a huge opportunity for an investor or a trader.
Excellent.
Cool.
We have a question coming in here from Nico about do you look at float? Is that anything that we should be paying attention to as a trader?
Yeah, it's definitely something you should be paying attention to. The sort of discrepancy here is the number of shares outstanding versus the float. So number of shares outstanding is how many shares are actually out there in the marketplace. If a company has a low float or a low number of outstanding shares, it means physically, literally, that there's just less shares to go around. So, I mentioned that Bank of America has some days over 1 billion shares traded. I'm not sure exactly what Bank of America's outstanding shares or float are, but I'm guessing it's probably over like 10 or 15 billion shares, meaning out in the marketplace at any given moment there are 10 to 15 billion shares out there. When you have a low float or a higher float company, that's also a really good indication of liquidity, of potential interest in a company.
Great
question. Thanks, Nico. All right, last section I want to touch on really quickly, and we are starting to get a little bit advanced here, so I'm just going to touch on this stuff. When you're looking at a chart, there is a number of traders out there, a lot of traders out there in the marketplace who are looking at the behavior that's going on at certain levels in a stock's price, and that is called the technicals. You're going to hear technicians being referred to, and what a technician does is they look for tendencies. They look for repeat behaviors in a chart, and then they use that to their advantage. So, like as a very basic example, let's say that there is funds out there who know that over $100, they don't want to own stocks over $100. Like there's actually funds out there who put a price range on the stocks that the traders can buy. Their traders can't buy shares that are, no matter what the company is, that are over $100. There are traders, there's firms that don't let their investors and traders buy stocks that are under $5. So if a stock that you own or are thinking about owning is coming up to an important technical level like $100, and there is an instance where you've heard that a fund that you know is in a stock doesn't like to trade stocks over $100, what that could mean for you is it could mean that when the stock goes over $100, when it goes to 101, it means that those fund holders might actually be forced to sell. So that is what's called a resistance level. There is something on the way up that is resisting that tendency for the stock to keep going higher. Support is the other side of that. Support is where a stock might be moving lower. A stock could potentially bounce at a level like $5 as more investors step up to the $5 level and want to put their money in. Maybe they got burned last time. They let the stock go under $5 and they didn't buy it. So they think about that time again and they go, I remember the last time when the stock went to $4.95, I got scared that it was under $5 and I sold all my shares and then the stock bounced over $5 and went a ton higher. That's the thing that people think about, and that's where psychology really gets into this market, and that's where you really start to understand that what technicals are is sort of like a visual representation of human behavior in a marketplace. So again, that's kind of like some more advanced stuff. We could have a whole webinar on technicals if we wanted. It is important, though. It is a major part of how I like to look at stocks, and I think that you should too. So I wanted to highlight that, but I don't think we should get too in depth to it.
Excellent. So Brent, anything else that you want to add here before we kind of show you guys how to leverage some of these things on the Benzing Pro platform?
I don't think so. The stuff that, let me add this really quick. The stuff that we talked about, it seems like a lot of stuff. There's a ton of platforms. There's a ton of different platforms you could be using for each of these. But Mike, gladly, thankfully, our team here at Benzing has developed something where you can do the vast majority of everything I just went over inside of one platform, and that platform is Benzing Pro.
Excellent. So let me show you guys really quickly just kind of how to leverage some tools that we have that are available. So I will pull it up right now. If you guys would like to, you can sign up for a free trial right here. All you would do is just go to this URL. I'll drop it here into the chat for you guys.
Pro.benzinga.com. Pro, like professional, .benzinga.com. BENZINGA.com.
Excellent. Then you just click start your free trial. Since I have a free trial, you can either hit register or log in. When you hit register, you just have to fill out this information, hit next, and then it will generate an email with the login credentials that you just created.
And here it is, ladies and gentlemen, Benzing Pro, introducing Benzing Pro.
And it is, you know, everything that Brent talked about, you know, researching a stock. If you wanted to check out the press releases, the SEC filings on Facebook, all you'd have to do is click on that ticker symbol, and you would notice right here at the bottom, you have all of the news. You have a nice little daily candle chart right here. And you could see right here, whether it was an SEC filing, whether it was a press release, or just some company news coming through your platform right here, would just very easy to access. You'll have here on the right hand side the current ask, the current bid.
But there's your volume, there's your price right there, there's your chart. Go down, keep going out. There's your market cap. Actually, go back up real quick, Mike. We highlight, keep going. So will you highlight market cap right here? Just highlight it with your mouse. There's your market cap. We're looking at, by default, when you click on this widget, it's going to go, this is Apple. No, this is Apple, right?
Nope,
no, Facebook. I'm sorry. So here is the market cap of Facebook. It's sitting just under $500 billion. There is a little perspective over here on the right side. There you go, kind of mouse over that. So that gives you an indication of, in the industry that Facebook's in, the technology industry, most of the companies are under that valuation. What that little green screen there is giving you sort of a proportion of where in this metric that you're currently looking at, the current line that you're looking at, the company that you're looking at stands. So I want you to keep scrolling down real quick here, Mike. We've got a couple other key ratios. You got your PE ratio there. You've got, you know, your current ratio right there. Look at Facebook's current ratio. They have about 12 times more assets than they do liabilities. Keep going, Mike. And look, here's a quick little description. This profile right here. Here's a quick little description of what the company does.
Excellent. And yeah, you can find all of that right here. You could even click over to the calendar you'll see here that you have the earnings. If you wanted to see when Facebook reports next, all you'd have to do is just type in the ticker symbol, hit enter, and you could see, you know, the next reporting date for Facebook. So you know there'll be some volatility near that date.
And real quick, Mike, so you mouse over this right here. So this is showing you unconfirmed. Wanted to make it clear that this is an extrapolated date. It's based on, you know, historically, Facebook has reported about November 2nd, November 4th. Our system is extrapolating this earnings report out, and it's suggesting that you're probably going to get your earnings during the first day of November. However, it's not confirmed as of yet.
Excellent. And once it is confirmed, it will it will show up right there.
Yep.
If you wanted to see what some analysts were saying, you'd have all of your analyst ratings right here in one spot. Very easy to use, easy to read. Anything else that you want to add about the Benzing Pro platform?
You super quickly touched on that. The only other thing that I wanted to show off that I had in my notes here was, can you show the users how to filter by sector?
Absolutely.
So like use the news feed and really quickly show us some of these filters, Mike.
So yep, right here, it would just be that simple. So right here, this is the default to our news feed. We would just go ahead and click the sector icon since we're talking technology.
Yep.
If we wanted, like Brent said, there are these different subsectors inside of the technology sector. And if we wanted all of them, we could just click on the check right there. If we only wanted, say, application software, we could do so right there. And we could even get more granular if we wanted to by just kind of building that tree.
And so what this filtering is doing here is you're only going to see headlines back over here in your newsfeed widget. Is you're only going to see sectors, you're only going to see headlines and stories that are applying to the current sector that you filtered by.
Yep.
So those were kind of the things that I wanted to highlight. Do we got a couple of questions to go over, Mike, or do we not have time to get to them?
It is, yeah, we are wrapping up here. So if anyone does have any questions, feel free.
Ava had a good question here. I just want to get to real quick, Mike. So would you mind clicking over to the details widget really quickly?
Yep, absolutely.
So click over to details. Ava's asking if the charts are customizable to be black print on white silver background. What you can do is you can click to this chart tab, Ava, and the other listeners that are using this, and you can get a ton more advanced charting options here. You get a different color. Look at, there's all these different, styles that you can do. You can put different tools in. You can put different analyses. You can put in different drawing abilities, all that kind of good stuff.
Absolutely. Yep. So you can, definitely leverage some of these different indicators, these fundamentals, and always taking feedback over here. So, let us know what you guys would like to see. If you guys did have the opportunity to have, different monitors set up in front of you, you could pop each of these out into a new window. It is really built for a lot of different trading styles. And what you're going to find on here is mainly the U.S. equities coverage.
Put it this way, Ricky, if a news item could impact a U.S. traded security, we're going to cover it. So we are not focused on what Adidas is doing, for example, or Volkswagen is doing, for example. However, both of those companies do have U.S. traded tickers. So if there is news, we are going to publish stuff on it. And this is recorded. We have been recording this. This will be available for you to watch and listen to at your leisure. I don't know how long it's going to take to get the recording up. It should be pretty quick.
Probably a couple hours.
Couple hours is from our
TechMan.
TechMan comes in and says a couple hours.
But yeah, thank you guys for joining us. I think we hit all the questions. We probably missed a couple things here and there, and we look for you guys to tell us the feedback on areas we can improve.
Absolutely, and give us some ideas too. This was kind of something that we sort of shot from the hip a little bit, and started basic, how to research stock. If you guys have stuff that you want us to talk about, we're ears wide open. We're listening for your ideas.
Absolutely, and kind of just to let you guys know, currently our current process is what we're thinking about is just to kind of build off of this topic. So start to get a little more advanced as we go week by week. And if the derivatives was a great thing that we can add. So be watching that in the future. But yeah, from Detroit here, from the headquarters, we are signing out.